When one currency goes away, another one comes into its place. And what we've been witnessing is that they want us in CBDCs or digital surveillance currencies. So if you do something that they don't like, we've already been doing a lot of self-censorship, but if you do something they don't like, boom, they push a button and too bad, so sad. You have no more access to your wealth. Look at Canada and the trucker strike, which was a perfectly legal strike, and they took away anybody's ability or anybody that participated or supported the strikers' ability to access not just their bank accounts, their insurances, everything. That is a means of control, and CBDCs will be that means of control if we allow it. And the way that you allow it is by having all of your wealth in those fiat markets, in the stock market, in the bond market, in the markets where all you can do is convert into these dollars. I would say that the public is probably more aware than we're giving them credit for, and they need to be, because we need to create a sound money movement, and it needs to happen on a global basis, both local and global. But I really do not want the central bank saying, oh, you haven't spent enough money. Let's push those rates into negative, deeply negative, so that you're watching your bank account go down, even though you know you're not spending any money. The 15 years of zero interest rate policy forced those banks to buy all of that government debt. So if this is interest rates and this is the market value, as the central banks ratcheted up the interest rates, the value of any of those debt holdings in the banking system collapsed to negative. So when you look at the start of the regional banking crisis that happened in March of 2023, it's because there was a run on the bank and the public got nervous and started pulling their money out, and the bank's assets were underwater. Well, every single bank is underwater. And even a quarter of a point, that's not going to do really anything to these valuations. So what they're really trying to prevent are runs on the bank. And the reality is when those banks closed, they bailed everybody out, whether it was the insured depositors or the uninsured depositors. And when you look at that chart, well, when did they start QE? That was 2009. At that point, you can see that the uninsured deposits were just way below the insured deposits. But with all of this money that's been floating around in the system, now you can see that those uninsured deposits make the insured deposits look like almost nothing, comparatively speaking. So there will be bail-ins, but I believe that the central bank and the Treasury Department, Janet Yellen, there will be bail-ins when we least expect it. Because once you make that deposit, legally, you have loaned that bank that money. That's why nobody went to jail in 2008, because it really wasn't your money. It's all a big contract. Nobody reads the fine print. They have all the control and the safe harbor. So they can say, no, you can't have your money back. There will be bail-ins. The FDIC knows it. And that's another thing that I find really interesting, because the most current data still goes back to the first quarter of this year. Why don't we have the second quarters, at least through the first half of the year? I don't know the answer to that. But what I do know is they have barely more than 1 penny for every insured dollar. So if they can control the implosion, maybe they can hide it a little bit more, but they really can't. They don't have any money. It's called the DIF account, DIF, and that's the Deposit Insurance Fund. So the banks are insolvent. They're insolvent with their assets. They are gambling with your deposits. Most of their revenues are generated by trading. We are taught that, okay, you make this deposit and they pay you this much, and then they loan that money out for a little bit more. And that's how they make that their money, is through that spread. That's not true anymore. They make their money once they allowed risk-taking banks and deposit-taking banks to merge. They make their money by trading. And we have no idea of the level of risk because of the level of derivatives in the banking system and the changes in accounting to hide the risk that they're taking. And that's in the Office of the Comptroller of the Currency. They do it every quarter on derivatives in the banking system. And a derivative is a leveraged bet. Debt upon debt upon debt upon debt upon debt. I mean, if anybody wants to read it, it's very scary. As they start reducing rates, they're doing that to generate inflation. So have they gone too far with holding the rates up at this level? I don't know. We're about to find out. But dropping the rates to prevent the collapse of the corporations, because corporations are certain that the Fed's going to drop the rates more than a quarter basis points, right? But there seems to be a global flood of new corporate issuance of debt. Why are they issuing debt at these higher rates? When you know that you're going bankrupt, spend all the money you want. It doesn't really matter what the interest is, because I think that the collapse is, I think 2024 was a very pivotal year. I think 2025 is going to be a much more visual year. I think that the rules that have been put in place that create an awful lot of market volatility, that short-termism. And what did the talking heads say? Well, if you're a long-term investor, don't worry about it. So I think we're going to see a tremendous amount of market volatility. Will it be covered up by more interest rates dropping? I think in 2025, we very well could see interest rates drop back to zero. However, that's not going to fix the problem. They're between a rock and a hard place, because when they lower that interest rate, it's going to create more inflation. They create more inflation, the public notices, because they can't buy as much with the dollars that they're earning. And now in the labor market, it's a soft labor market where you have fewer job openings, more layoffs. Everything is dependent on the consumer consuming, but boy, is that really what they're going to be able to do. So I think that next year in 2025 is when we're going to see a spike in unemployment at the same time that we have a spike in inflation. And I think it will become obvious and continue. And whether or not consumer confidence will completely erode in 2025, but it could. When the faith is lost, history shows us 100% of the time that they will come in and they will bring gold as a backing of the currency. Not 100% backed, but a percentage backed. It's why I'm watching Zimbabwe so closely with their ZIG, Zimbabwe gold, that is presumably partially backed by gold, and then foreign currencies, which I think are the dollar. It's really hard to ferret out all that information because they're not really forthcoming with it. But they're having trouble adopting it because it's non-convertible. So they can say anything. But yes, and when you talk about a universal currency, the IMF and their currency, which is a basket of currencies, and there's no limitations. They could put every single currency in that basket. They've been working very, very diligently on creating that universal currency. And so I think, and even when you're talking about the BRICS countries are voraciously accumulating gold. Western countries like the US and the other advanced economies, not accumulating so much. But those that are part of the BRICS nation, yes, they are. And there are a number of countries that are repatriating their gold, because if you don't hold it, you don't own it, and they know it. So they're calling in their gold so that it's close to home and they have full access to it. And the one that probably makes me the most nervous is Saudi Arabia. And I say that because they're the ones that have supported a petrodollar, even though that hasn't been kind of fully accurate, but they became a member of the BRICS. They are repatriating their gold. They are growing the gold that they have in deep storage, and they are distancing themselves to a degree from the US. I feel so strongly that everybody all around the world needs to own gold and silver. But what should I recommend, right? Should I recommend the stock market that I know is severely inflated and garbage? Should I recommend the real estate market? I could say the same thing about it. It's severely overvalued. I believe so strongly that you need to have the lion's share of your wealth in an undervalued asset that is in a long-term positive trend, and the least amount of your wealth in an overvalued asset that is in a long-term negative trend. Even the manipulated spot gold market is in a long-term positive trend. And you know that because there is a series of higher and higher lows. And if you keep getting higher lows, you're going to get higher highs. On the flip side, the real trend is in the purchasing power of the currency, because 1 trillion times zero is zero. And you know you're in a negative trend when you see lower and lower highs, but go to the grocery store, try and buy some insurance. In some cases, you can't even do that anymore. But anything that you're buying costs you more of this stuff. That's the real trend, not the stock market going up. We saw Venezuela, we see in Zimbabwe. Oh yeah, Zimbabwe, when they did their overnight reset back, what was it, April 8th or something like that? The stock market lost 360%, bam. So people fly to that thinking that that's going to protect them from the inflation, when in reality, you can only convert it back into this. So I'm doing gold and silver because I know that that's what we need. We need sound money. This is a currency life cycle issue. And so what are the currency metals? Primarily gold, secondarily silver. It means that it holds its purchasing power over time. I mean, what value do we have but our labor, right? And our time. That's really what we have. And so if I get paid today, I want to be able to save that money to use it sometime in the future, but I want to pay the same amount as when I earned it. With this stuff, that doesn't happen by design. But with this stuff, it does. So sound money means that you hold your purchasing power over time and you are always fairly paid for your labor. Sound money is what does that. The fiat does not do that.